Hey everybody, it's Seth and Paul with the Everything Money channel. We welcome you in. Pfizer was one of our biggest videos we've ever had. We looked at the company and the financial health. We used our 8 pillars just a few weeks ago to look at like what's really happening. Obviously, they're coming out with this vaccine. They've had some good news with the vaccine. They're going to be producing more of it. They're going to be producing, it's stretching to other avenues across the world. And I'm seeing reports out of other countries that they're using it. And so there's good news on Pfizer, yet the stock price is a bit down. So we want to do a deeper dive on Pfizer. We did our 8-pillar analysis, which we're somewhat famous for, and Paul decided that he wanted to look at this company a little more in depth. The 8-pillar analysis is our general 500-foot view to see if we're interested in a company, if it's good buy, and we want to look a little closer into the numbers. In the future, if you're a patron member, this will be more of an exclusive content just for you. So we do these videos all the time, folks. We have hundreds of videos on our channel where we look at the financial health of companies and determine, in Paul's opinion, whether it's a buy or an avoid. And what we're going to try and do is start doing these videos just for YouTube and then continue the look for our patrons. We want to deliver more and more content just for you, our amazing patrons that support us. But
in
Paul,
addition
go ahead,
to the
Paul.
software that our patrons will all get for free, this will be part of the exclusive content they will get. So the Patreon page is really geared towards patrons, the software, and making it a community for them to be able to learn more and get more out of the investing portions we do.
Tell me an update on Pfizer.
All right, so we did Pfizer a while back. What was it, mid-December or so?
Yeah.
So not a lot has changed in terms of financials, but one thing I want to show is for everybody talks about growth. This is Pfizer from 1970, basically. Look at this run up to 2000. Guys, this is 1999 right here.
Oh yeah, look at that.
It has never crossed back over that mark. So if you were that growth person who would tell me back in 1997, 1998, Paul, you're missing out, this thing is going to the moon.
Yeah, I think right there, Paul, put a big circle right where you just did that. That right there, folks, if there was a YouTube, you would be seeing the 10x to the moon rocket emojis, and that nothing is going to slow Pfizer down. And sure enough, it happened, Paul.
And sure enough, it went as low as $12 a share, roughly in 2009, and back up to 37. But if you'd bought Pfizer here, you'd still barely have broken even. But with your dividends, you'd have made some money. But in terms of share value, it would have taken you 20 years to even break even. So that's what I want to show here, because I want to make sure people realize that when they tell me I'm wrong on growth, this is what growth looks like. When you overpay for growth, this is what it looks like.
If this is for the first time you see us, what Paul is bringing up is that we have a very disciplined, steady approach to investing. We are not pushing 10x, 20x, 30x stocks. We are definitely not pushing the hype stocks, the Teslas, the NIOs, the workhorses. We push very boring. We analyze and love looking at very boring, steady companies that can make us money and without the headache. So Paul can rest easy at night with his 4 dogs. So keep going on Pfizer, Paul.
So Pfizer, $208 billion market cap, 24 PE. So it's an X to start on the PE. We want to look sub 20. Historical average is 15, but we're willing to pay a little more for some decent growth. So I always sit there and say, let's start with 20, but it is an X to start. Now, profit margin.
Pillar number 2.
18% in the last quarter. We want to look at the last year, about 18% again. I don't know the exact number, but it's a check mark there. It's definitely over 10%.
What about the dividend, Paul?
The dividend, great question. It's not a pillar, but we always look at the dividend, 4%. So on $208 billion, to be conservative, to be low, make it easy, $8 billion dividend. So we need to make sure the company can support it, because most people out there think, oh, a company pays a dividend, it won't go away. You got to look at the free cash flow. Free cash flow is one of the last things we look at, but one of the most important. It'll show us, can we actually support paying that dividend?
We'll look at free cash flow, pillar number 7. But first, we want to look at the revenue growth, which is pillar number 3, Paul.
Okay, a big company here. I don't imagine a lot of revenue growth. And I'm right, 48.9 to 51.7. So automatically, guys, your multiple should be lower. You should be willing to pay lesser of a PE ratio and lesser of a price to free cash flow. The less growth, the more money you need the less money you need to pay for it, because you need to see that money back in your hands a lot faster.
And again, we'll come back to this with pillar number 8, is we're going to multiply our free cash flow by a multiple, and with a slow growing company, we want that multiple to be a bit lower. Profit growth is pillar number 4, Paul.
7 billion, 16 billion, check mark there. Now there is big growth in the profit here. So that could affect that ratio again, but we'll look at that later. But there is big growth in the profit.
Pillar number 5 is the number of actual shares outstanding. We want this going down.
Praise the Lord. 6.17 down to 5.56. So in addition to paying out dividends, they're hopefully using their free cash flow to buy back shares. What does that mean? when they're buying back shares, folks, they're giving you a bigger piece of the pie. This is the company. This is the example. There's 8 pieces of pie, 8 pieces of pizza, right? When they issue more shares, they're cutting up the company into more slices. You get a smaller piece of each and every piece of the company. When they're taking shares away, they're giving you bigger pieces of the pie. So the same company size is not being affected, the same revenue, the same profit, but they're just splitting it up. When they're taking shares away, they're splitting it up amongst less owners, which means you get a bigger percentage of that company. When they're increasing the shares, you're getting less percentage of that company by owning the same number of shares. So that's something very important that not many people look at, but we do here at Everything Money.
Pillar number 6 is current assets greater than current liabilities, Paul.
So we go to the balance sheet and we look at the current assets. 47.74 billion. Current liabilities, 34.15. Definite check mark there. So they have plenty of cash on hand to pay their current debts.
Where it all checks, Paul, except a PE ratio, which is a smidge high at 24.
Yep.
Let's go to pillar number 7, which is free cash flow. And stay tuned, folks. This is where it gets down to the nitty gritty here.
So remember, this is a $200 billion company. I want to remember let's call it $200 billion, but it's 209. Free cash flow is cash from operations less your capital expenditures. It's found on the cash flow statement. Now, 14.6 minus 1.5 is 13.2, and last year they did 10 billion. So it's actually an X. Their free cash flow has decreased in the last 5 years. Let's look at the average. 14.2, 14.6, 13.6. So Seth, what's the average over the last 5 years?
13.1.
So call it 13 billion. So right now, their price to free cash flow is, Seth, what's 200 divided by 13? Their price to free cash flow is around 15. That's pretty good. It's a slow-growing company, but it's a big, big company. The factors that are involved in what ratio you want to pay is faster growing, you want to pay a higher ratio, but also if it's a very established company with a good track record, pharmaceutical, things like that, Pfizer is a well-known name. Now, we will go when we go deeper dive, we're going to look at what their potential is, but it doesn't look like it's bad here. The PE ratio is a little misleading here. The price to free cash flow is nice here. So what are you going to pay for it? That's a matter for you to decide on the prospects for the future. The prospects for this company, let's go into a little deeper dive now, aren't as good in my opinion as other companies. There are other biopharmaceutical companies that I like a little bit more. Check out our past videos. Things like Biogen, I like a little bit more. But what I do is, when I go into a deeper dive, I'm looking at a 10K, which is their official annual document that they file with the SEC, and I go look at other people's reports, positive and negative in the company, to see what they're saying. Because part of investing is getting other people's opinions on things you might have missed. So here are some of the things that I found as pros for Pfizer. First one, this vaccine is generating a lot of attention for them. Okay, I don't know if it's a pro or con. I put it as a pro because it'll hopefully get them more funding in the future for other ventures, other drugs, etc. Get them on the forefront, prove to the government they can work fast, and hopefully it'll help their other approvals in the future go faster. Second thing I liked, they can cut costs. This is also a negative, but these are the pros right now. There's a lot of Cust caught. Did
What
you
is
see what I
see what you wrote there. That's interesting. Cust caught.
So I'm cost cutting. It's a very easy way for big companies, especially, and I do believe that all major companies have major inefficiencies. They can cut costs pretty quick, and I thought I did it wrong again, and generate some more profit for them. It seems like they did that in the last few years, so who knows how much it's going to go. The reason it's a negative also, we'll get into that in a little bit, but the other big thing in their 10K that I found, this is their 3 things. Phase 1, Phase 2, and Phase 3 drugs. The number they have going right now. Phase 1, they have 26 drugs. Phase 2, 37. Phase 3, 23 drugs. This is a lot, guys.
Yes.
There's a lot of drugs they have currently in these phases, and phase 3 is about a 58% approval rating. So they already have 12, 13 drugs in there that stand a chance to be approved. So these are the positives of it. Now, let's go to the negatives on Pfizer because there's always negatives to every company. Just like when you get married, there's always a negative to your significant other. You have to weigh them about the. You have to weigh them against the positives.
Not if they marry you though, Paul.
Yeah, well, that's gonna be a big disaster for them. So I don't like the fact that they cut their profit guidance big time. They recently just cut their profit guidance from I believe the market was expecting $3.16 per share, and they cut it down to $3 a share. That's a big miss. That's a big guidance cut. I don't like that. I'm wondering if they're trying to hedge for the future. Who knows? The other, remember I said cost cutting was a negative? I don't like when companies do this as their way of generating more profit. Where are they going to cut costs? Is they going to take away from future growth? Are they just trying to hit numbers for investors? I don't like that. I want companies who want to think long term. If they need to put more money into research and development, go do it. It's a very easy place to cut costs at. I don't like that. Next thing is their free cash flow, big problem. $8 billion of $10 billion last year.
Yeah, I saw that. They have a 4% dividend, which is $8 billion, but their free cash flow was only $10 billion.
And their CEO said this is a big thing for them. They want to keep this dividend going. Why? Because they know people watch that dividend, and it helps drive the stock up. But it takes up a big chunk of their free cash flow. I do not like that. I'm hearing things from the CEO that makes me think they're looking for more of what's the image going to show versus what's best for the company. Mm-hmm. I think there are other better buys out there for Pfizer. This is part of the deeper dive we're going to do into companies as we go forward and provide them to the Patreon level. Let's kind of look about what are the pros and cons for each company on a deeper dive while reading the 10K, doing other research.
What's your final take home on Pfizer? What would you?
I'm avoiding Pfizer. That's my opinion. At $37 a share, at $209 billion market cap, with the dividend eating up so much of the cash flow, I don't think it's attractive enough for me.
I would say with Paul's more disciplined approach, if you watch our videos, it's very far in between, far and few the companies that we actually really fall in love with. We've been in love with Biogen for months. We've done multiple videos on it, and it is still slaying. So there are better companies if you kind of can ignore the hype and maybe follow a road less traveled. It's a turtle versus a hare type story, and we're taking a slow path. Would you agree, Paul?
Yes, we are. But you know what? Slow and steady wins the race, guys. And it helps you sleep better at night. In my opinion, you don't have to worry about these massive fluctuations. It's just the way I learn. It's what works for your personality. My personality is more of, I went to bed last night at 10:15 and woke up this morning at 7:15. I had 9 hours of sleep last night. It was wonderful.
And you're not worried about your money going up and down in drastic
and I woke up wondering myself, like, oh, I wonder if I'm going to make money today or not. If I lose money, it's not going to be much. If I make money, it's not going to be a ton. Yeah. There'll be enough that over time, it'll add up to big numbers.
If you like the way this sounds, join our Patreon. The link is in the description below. We just hit 500 members. It's astounding. We have people following us all over the world, and we appreciate you. And we have big giveaways this year for our patrons, including 2 Teslas, which is completely absurd. We have so much planned for our patrons and giving back to them for their support of us, and really them making a decision to learn and be better. And so, we invite you along on this amazing road, and we appreciate your support. So, all right, Paul, that was it. That was Pfizer. Wow, what a company.
Awesome. Thank you very much.
See you guys.